So today we're going to be looking at IAS 23, which is on borrowing costs. Okay. So when we talk about IAS 23, we're talking about the cost of uh, financing projects in which we try as much as possible to distinguish between the principal sum and the interest payable on the money being borrowed. Now, over the years, we know that when we prepare our book of account, that is the final account, most especially the profit or loss account, or what we now call income statement, we do expense the interest, which is a charge against the profit made by the business during the financial year. So what IAS 23 is trying to say is that IAS 23 is trying to make clarifications in regards to the expenses or the cost of borrowing that has to be either capitalized or expensed, okay, in the various accounts. So what do I mean by capitalized and expense? Okay, now when we're talking about capitalization, we're talking about including the cost of borrowing, okay, on the initial cost of the asset. That is the cost by which we use to acquire the asset and other costs that, such as the interest on the borrowed funds, okay, we add it to the initial cost of that asset. That we were simply doing by capitalizing. On the other hand, when we are classifying it as expenses, we are simply saying that that the cost of borrowing, okay, should be recognized in the income statement as an expenses, which is a charge against the profit and profit or loss. Okay, so IAS 23 has been able to make further clarifications, okay, in regards to when to expense, okay, and when to capitalize, okay. So what do we mean by borrowing costs, okay? So borrowing costs, according to IAS 23, is a cost what incurred, okay. It is the cost incurred in financing a project, okay. It is a cost incurred in financing a project or bringing a product to completion, okay, which may take a couple of years, okay, to be able to actualize. So this cost entails the initial sum being borrowed, which is the principal sum, and also the interest or the finance charge payable on the funds being borrowed, okay. So when we talk about borrowing costs according to IAS 23, there are various components, okay. We have various components of borrowing costs, okay. From our definition, we're talking about the principal sum and the interest. The principal sum and the interest, okay. So this interest is the additional cost, okay, on the amount of funds being borrowed. So the components of borrowing costs, we have interest involved, that is the amount payable or the additional cost incurred on the funds that are being borrowed, okay. And also we also have what we call the auxiliary costs, okay. We have the auxiliary costs. When we talk about auxiliary costs, we're talking about those other charges, okay, those other charges that are imminent or attached to the borrowing, those other charges that aid, okay, in making the borrowing easy, or that are part of the borrowing, the funds being borrowed at a given period of time. For example, let me give you an example. When we talk about service charges, okay, when you borrow funds in a bank, okay, the bank tends to, before they borrow you the money, they have to go through some paperwork, okay, paperwork like the the service charge, maybe some other costs, maybe VAT, maybe some management fee and others. These are what they are all auxiliary. They are what we call auxiliary costs. Okay, these are also part of the components of what of borrowing costs. Okay, so whenever we come across all these costs, they also form a part, okay, of what we mean by borrowing costs. Okay, so we have to consider that too, please. So the other one is that we have amortization. Okay, we have the amortization cost of both discount and principal. What we are saying is that when we amortize, that is, we are trying to spread costs that can be spread, okay, over a given period of time, maybe 2 3 years. You can spread this cost. Okay, these costs are also incurred, amortization costs. Okay, now what that being set aside, okay, over a given period of time. So these costs are also part of the borrowing cost. For example, we talk about amortization cost of principal of the which can either be premium or of the discount given on the principal sum. So let me give you an example. For example, assuming that you were given a loan, okay, to finance a construction, okay, and you are given 100,000. Let's just assume that you're given $100,000, okay, to finance the project. And at the end of the day, you were told that if you are going to be able to make a quick payment, you're going to be given a discount of 10% on the $100,000. And you are what? You are meant to what? To pay the money back within 5 years. So by meeting up with the conditions, you're going to be given what? A discount on the principal sum. So kindly note, please. Now, what we are saying is that you have $100,000 as a principal sum, assuming you are going to be paying 10% interest, okay? 10% interest on the borrowed funds, okay? And also, you're going to be given a discount of 5% instead of 5% on the borrowed funds. If you're able to pay up or meet the conditions, you'll be given 5% within a 5-year period. So what we are saying in essence is that for the 5-year period, okay, which is 5% of 100,000, okay, 5% of 100,000, that is 100,000, 5%, that is $5,000, okay, meaning that at the end of the day, you are going to have $5,000 discount on the borrowed funds. And this $5,000 will be spread within the 5-year period. That is, if you're going to recognize the amortized funds, okay, within the 5 years that you are putting this money into what? Into the construction or actualization of the project, then you have to what? You have to consider this $5,000 within the, you are going to spread it within the 5-year period, okay? So that is 5,000 divided by 5, you're going to have $1,000 in every year, which you're going to amortize, okay? And you're going to include in the cost of borrowing, which you're going to capitalize, okay, because this money covers the useful life, okay, to the period from construction to when the asset is being made to use, which is a qualifying asset, okay. You're going to what? You're going to be incurring this cost, okay, and at the end of the day, you're going to spread the discount within this period. So that is every year, 5,000 divided by 5, you're going to be what? You're going to be having a discount of $1,000, sorry, on the borrowed fund. The same thing applies to premium too. In terms of premium, when we talk about premium, okay, premium means that you're going to be making additional payment, okay, to the cost of borrowing, that is to the borrowed funds, okay. That means, which means that if you're having a principal sum, you're going to be making additional payment, okay, which is a premium based on some certain conditions that you may be enjoying from borrowing that funds, okay. So um these are what we call amortization of what of funds, such as the premium and the discount. Okay. We also have amortization of okay. We talk about amortization. We talk about the amortization of what auxiliary costs. Okay, which I've said earlier. We also have what we call exchange rate differences. Okay, we have exchange rate differences. These exchange rate differences can also contribute to the borrowing cost. Okay, so they are components of borrowing cost. So what we are saying in essence is that the borrowed funds can be affected due to foreign exchange differences, okay, which you're going to recognize. For example, maybe the dollar rate has increased over the years when you borrow the funds, okay. So these changes what that have occurred in exchange rate, okay, you have to also what recognize that in your um in your account, okay. You have to recognize. So the finance charge is the charges against the money being borrowed, okay. either from the financial institutions, from creditors in the form of debenture loans. Okay, so these charges, okay, are recognized as well as the cost of borrowing. That is the initial cost plus the finance charge. Okay, which the borrower, okay, has to what, to recognize as either the as a part of the capital, okay, or as a part of the uh, capital, okay, and either to recognize as well as interest, okay. So when for us to be able to recognize a borrowing cost as capital, then it must be on a qualifying asset, okay. When we talk about qualifying asset, we're talking about assets that can take about 2 3 years, 4 years, 5 years down the line for you to be able to construct or build or transform to its usable form. Okay, so it means that what you have to spread this cost within the period of time for you to be able to utilize the money or funds being borrowed. Okay, so these charges also, they also recognize within the period of time by which you have borrowed the funds, you can capitalize it. And anything outside of that, you have to expense. Okay, so you have to recognize them as well as expenses. Okay, so as cost of the charge against the profit, which is what, which is interest. Okay, on the funds being borrowed, okay, so which you're going to be what you're going to expense at the end of the year. Okay, so now when we talk about, we're also going to talk about, we talk about inflation. Okay, we also have the issue of inflation. Inflation can also affect the cost of borrowing. Okay, when the value or the prices of goods or the price of for by which you're going to construct an item, a building, has gone up due to changes in what, in the currency. When products have gone, well, the price of products keep going high. When we have the case of demand pull inflation. Okay, when there's high demand for certain materials, maybe building materials, for you to be able to complete your project, the prices have gone up, okay, due to that inflation, which is demand pull. We also have cost push inflation, okay, when it's of the cost of products being on the increase, okay, so due to some economic factors. So all this has to be ingrained, okay, in the cost of the what, of the project, okay, or the asset being constructed or being built. Okay, so in this case, you are left to capitalize the borrowing cost. Okay, if it can be ascertained that the asset or the item which you are funding with the what, with the money being or monies being borrowed, okay, are qualifying asset. That is, they are assets that can take beyond 1 year, 2 3 4 5 years, okay, for you to be able to complete them and put them into proper use. Okay, so on this note, we're going to stop this discussion here, okay, and we're going to look at, in the next video, I'm going to be sharing the screen with you, and we're going to be doing some workings to really understand how borrowing costs according to IAS 23 works. So please kindly note that when we talk about interest, okay, we know that interest from the beginning has to be charges, can be simple interest. I don't think compounded interest is not likely to work in this case. So what we are doing is with interest, simple interest on the borrowed fund, that is on the principal sum, okay, which you're going to recognize as what, as a debit item, okay, on the interest, the expenses account, okay. So in this case, the charge, the interest is a charge against profit, and when you are capitalizing, okay, you are including it in the cost of that capital, which is going to increase on the other hand. So thank you very much for your time, and I'll see you in the next video. Please don't forget to subscribe to my YouTube channel at Illumination of NG, and also share this video with your friends and colleagues, and also click on the notification bell so that you can have access to any video, or you can be notified whenever I drop a new video. Thank you very much for your time, and have a good day. Bye.